and Risk at the Bank of England. Now, it's a particular privilege to have Alex with us today, as it will mark his last public appearance in this role before his term ends. Alex has been at the bank since 2001, taking up his current post in 2015. Now, I'm curious whether 6 years ago he might have entered the role with a cautious optimism that with the raft of reforms from the 2008 crisis largely in place, he might be set for a slightly less turbulent tenure than some of his predecessors. But his term has in fact been bookended by two seismic events, the 2016 Brexit referendum and of course the global pandemic. And on both counts, the long-term economic effects of these events are still very much unclear. So I'm really keen to hear from Alex a few reflections on the challenges he's faced in this role, and then discuss which parts of the global financial system he is still most worried about and the most pressing tasks that will face his successor. I've got a raft of questions lined up for him, and I'm also very keen to hear what you and the audience would like to ask. But first, we're going to begin with a few introductory words from Alex. So Alex, over to you.
Thank you, Rachel. Thanks for having me, and thanks everyone for attending virtually this afternoon. And thank you too for indulging me, because as Rachel says, this is my last few days in the job, and finishing any job makes you reflective. So I'd like this afternoon to reflect on 6 years as a member of the Financial Policy Committee at the Bank of England. And the job of the Financial Policy Committee, for the 99.9% of people who don't know, is basically to worry a lot about what could go wrong and make sure the financial system prepares for it before it does. The aim in doing that is really to ensure that finance can support the economy through thick and thin, rather than sideswipe it like it did back in 2008. And so to kick off our discussion this afternoon, I have three reflections about that job. And the first is a sort of predictable point from me, I think, but no less important. And it's that actually worrying about and preparing for what could have happened has served us pretty well. I'm sure that some people at times thought we were mad to worry about things that nobody particularly expected or forecasted. But on Brexit, for example, from the get-go after the referendum, we worried about the possibility of a hard Brexit. And so we made sure the financial system was prepared for that. And that meant that when Brexit came about and there was no deal on disruption of the provision of finance to speak of, without the preparation, there could have been. So because we worried about what could happen, we were ready. And then on banks and the economy, we spent a lot of time over recent years worrying about macro shocks or recessions. Nobody knew what would cause them or when they would come. But because we worried about what could happen, we stress tested the banks to it, and they built their capital buffers on the basis of it. They had the strength to deal with the economic shock of 2020 when it came along. So we had a public health crisis, but we didn't have a banking crisis alongside it. And had we not prepared for it, we could have had a banking crisis as well, just as we did in 2008. So that's my first point. Worrying about what could happen has actually served us pretty well. But my second point is that I'm not for a minute saying that everything is perfect. We've learned a lot in the past year about the way the financial system of the 21st century operates under stress. And there are, frankly, some things not to like. There's some unfinished business. Take banks, for example. Through stress tests and capital building, we've got the resilience in the banking system that means they can absorb pretty severe shocks. But it's become clear over time that the rules are too complex, and banks are not relaxed enough, not as relaxed as we are, about dipping into their buffers of capital so they can keep supporting the economy in a stress. So those are areas in need of reform. And take non-banks, there's unfinished business there too, because what happened in a range of important markets last March was unacceptable. Even government bond markets began to seize up because many of the non-bank participants in those markets were dashing for cash. They were struggling to meet their liquidity needs, and so they were forced sellers of a wide range of assets. And so reforms are needed now to the way central banks support markets and the way those non-bank players are regulated in order to avoid that sort of thing in the future. And no doubt we can come on to discuss that this afternoon. So that's the second point. There's a bunch of unfinished business, and we can come on to that. My third and final point, actually, is that despite the immediate challenges we face, it's really important that we have to start preparing now for some of the things that could happen and the challenges we will face in the future. Take climate change, for example. We're now about to stress test banks and insurers on the risks around climate change. Why? Well, we want to make sure that they're able to measure and manage the risks of their different exposures, taking account of the fact that our economy and lots of other economies will transition to net zero carbon emissions over time. And take the recessions of the future too. We could well enter them, whatever causes them, with less room for monetary policy maneuver than we've been used to in the past. So monetary policy may not be able to be the only game in town in future recessions. We might need a new recession policy playbook. And the past year, in which both monetary and fiscal policy have together supported the economy through this very difficult period, is a good basis for that future playbook. And I'm sure that as we recover from this, policymakers will actually be thinking well ahead of time, well ahead of the next recession, whatever causes it, about writing that playbook. As financial regulators, it's really important to us because without a new sort of recession policy playbook, we may need to acknowledge, as we did back in December actually, that with less room for monetary policy maneuver, downturns in future could be deeper or more prolonged than we've got used to in the past. And that means we have to put more resilience into the financial system to deal with that extra volatility, into banks, into non-banks, into corporate and household balance sheets. So we have to continue looking ahead to what could happen in the future that hasn't necessarily happened in the past, so that we can continue to have a financial system that's able to serve the economy through thick and thin in the future, just as it has done in the past. So once again, thanks, Rachel. Those are my 3 points. Worrying about what could happen has served us well. There's some unfinished business, and there are some new challenges to which our attention now has to and is turning for the future. Thanks.
Alex, thank you for so succinctly summing up such a kind of myriad of big issues that have been facing us. I was quite keen to jump back to your reflection, particularly on what was happening a year ago in March 2020. And you said that what happened in markets then was unacceptable. And obviously a lot of the focus back then, a lot of the cause of concern was what was happening in money markets back then. And perhaps for the 99.9% of us who aren't kind of completely au fait with kind of the FPC and what it does, can you talk us through what were your big worries then when you saw what happened in money markets? If there wasn't central bank action, what were your big fears about what would happen at that point in time?
Okay. Well, it's interesting that it wasn't just money markets that seized up. Actually, it was money markets, it was broader corporate funding markets, and even, at one point, it looked like government bond markets were beginning to seize up as well. So it sort of spread through the system. And each of those is a problem for the wider economy. Money markets, because they're a source of liquidity for companies and banks. Corporate funding markets, because over time, bond issuance in particular was threatening to have a big effect on the economy at a time when, frankly, it needed the exact opposite. It needed looser financial conditions rather than tighter financial conditions. And the question in our minds was, well, why is this happening? And we knew there were some vulnerabilities in some non-banks and areas of finance, but I think what was surprising last March was quite how they all came together. So what started as a kind of risk-off sale in a range of markets, which is to be expected in an event like we saw last March, actually turned into this dash for cash and forced sales of a very wide range of assets by a very wide range of market participants. And just as each unhappy family is unhappy in its own way, each of them had their own motivation pressures from their investors. They needed cash. Some pension funds, other funds were facing margin calls on their derivative positions that they needed to post in cash, so they needed cash as well. And some hedge funds were actually scrambling for cash because their funding conditions have been tightened in response to the higher market volatility. So we saw how a sort of understandable risk-off situation in markets could turn into a widespread fire sale. Now, the cure for that was very simple and very effective, and it was large-scale asset purchases by central banks. As Andrew Bailey later described it, go big, go fast. It's effectively like opening a facility for everybody that says we will purchase X billion every few days. So if you need cash in exchange for your assets, there's a way to do it. So it's very simple, very effective. So why the worry, I suppose? Actually, it's two reasons. One is through large-scale asset purchases as the solution to this, you don't necessarily create the best incentives for sound kind of cash and liquidity management in the non-bank sector in the future. You create, at the limit, perceptions of a central bank put on liquidity conditions. So it doesn't necessarily create the right incentives. The second reason is that you can't always guarantee that if this happened in future, you'd be in a position where monetary policy was wanting to loosen. This time we were in that position, so you could use effectively a monetary policy instrument to deal with the problem. Can't always guarantee that in the future. And that's why now we really need two things, I suppose. One is central banks need to examine the way they provide liquidity to support markets. We can't just let these markets malfunction. They're too important to the economy. But the question for us is, can we support them in a way that creates better incentives for people to manage their own cash positions in future? Maybe there's a penalty on the use of the facility. Maybe there's a cost to using it. And at the same time, the second thing we need to do is look at whether we need guardrails in the non-bank system in order to stop that central bank support that's needed for markets being exploited. And that's why internationally now, and this has to be done internationally because these markets are global, it is through the Financial Stability Board, we're looking at what guardrails are needed in lots of non-bank institutions in order to avoid a situation developing like it did last March. And I think I just go back to looking at it then, we knew lots of these vulnerabilities existed. What was a surprise to us was how they could all come together and create this type of event in a number of important markets.
And do you have, because when we came out of the 2008 crisis, there was very much a global consensus around what needed to be done. Now, obviously, this has been a very different type of crisis, and governments have faced different kind of situations in terms of the scale of the pandemic in their markets. Is there kind of global consensus on those kind of guardrails and the other type of reforms to bring in? Is there going to be a unified position on that?
I think some, yes. I mean, this was a problem that many jurisdictions experienced. And so it's been reassuring that the Financial Stability Board, the G20, has picked this issue up because it does need global coordination to solve it. There's a lot of debate to be had about precisely what those guardrails should be and where they should be positioned and what's the case for them. And there's a lot of work to be done to explore these issues around central bank facilities. And so I think the fact that so many countries, so many jurisdictions had similar issues bodes well for the sort of post this crisis reform agenda. I would say, though, that this is very different from 2008, and this has both pluses and minuses. The plus here is that this is a very different level of problem to the one we had in 2008. We're not talking about the core of the system, the payments and credit system, the banking system. We're not talking about people who need a bailout, a gift from the taxpayer, like we were in 2008. We're just talking about how we can do things a bit better to create better incentives for people to manage their liquidity so that the cure we've got isn't exploited in future. And that's a sort of higher class of problem than the one we were faced with in 2008. As a result, it may be more difficult to achieve consensus around the reforms. But, I'd take that over what happened in 2008 when the problem was so bad and so obvious that you easily got consensus around reforms. But I'm hopeful. These discussions have been going on internationally. They will continue to go on internationally, and we are making progress.
One thing that's been bounced around a lot kind of before this crisis and afterwards is whether some of the non-bank actors, major asset managers, etc., need to have some kind of capital requirement. Where do you think the thinking is going?
Yeah, I don't think it's at all about capital. A lot of these institutions, and you talked about asset managers, they're not particularly leveraged. They are, and the end risks are with their investors. So they're not banks in the sense that they're offering people redemption of their money at face value on any occasion. The investor bears the risk. And that, I think, is the key reason why the shift over time since the crisis from banks towards things like investment funds has actually been a big positive for financial stability. The issues here are much more, if you like, subtle than they are with banks. With banks, it was how much more capital do they need? With things like investment funds, it's actually much more subtle. It's about the redemption terms they're offering. Are they too short? If they are short, are they being priced appropriately? Are they being priced in a way that actually encourages investors to try and redeem ahead of others in a stress? Now, those aren't issues to which there's an easy solution. We've tried to outline some, including in recent weeks, about how investment funds can more closely align the term of their redemption, the notice period, and the price the redeeming investor receives with the liquidity of the assets in the fund. So there are solutions here, but they are a long way from the sort of solutions we needed to apply to the banks after the crisis. They're not at all really about capital levels. I'd say the one exception to that is around the role of leverage in hedge funds in particular, or highly leveraged non-bank investors. It's not that they shouldn't be allowed to take risks. It's on their own account, and it's their investors that bear the consequences. But what we saw last March is how hedge funds, as one part of this, I wouldn't say they were the only part by any means, but as one part of this, had leveraged up and became effectively forced sellers in a number of important markets as they needed to unwind that leverage. And so there's a question, I think, about whether we need guardrails on this sort of aggregate amount of leverage these players can take, not to protect them, they should bear the consequences of their own actions, but actually to ensure that there's no collateral damage if they take too much risk and end up trying to disrupt, or not trying, but actually end up disrupting important markets. But these are not easy questions, and I really do want to push back on the suggestion that they're all about things like bank capital. These things are not at all like banks, and the solutions will need to be very bespoke and in some ways more subtle than they were with banks as well, which is one reason why it may take time and why the international work probably won't result in immediate conclusions. But it's important we get it right.
Thank you. I might come back to that point on hedge funds leverage a little later, given some events we're seeing today. But I did want to jump to banks per se, and the points you were making earlier. Now, banks post 2008, had to build up much bigger pools of capital, and as you said, that served them really well in this crisis. There was no concerns about the stability of the bank. But what we've not seen is kind of banks eat into that capital in any way. And you look at some of the UK banks, I think NatWest is kind of around the 18% level in its CET1 ratio. And we're at a time when, the real economy really needs the banks to be scaling up the lending to them. What are the kind of tweaks you think you can do to kind of incentivize that lending and for banks to go into their capital reserves at moments like this?
Yeah, this is a really important point because, as you say, the basic foundation is that the banks are much more resilient. So rule number one is don't have a banking crisis, and that got a tick. I think the question is, have we achieved maximum resilience of credit supply for the increased resilience of the banks? And I don't think we have quite yet. And the issue is, as you allude to, which is that banks aren't as relaxed as we are about, if they take losses, dipping into those capital buffers whilst also maintaining lending. And that's a problem from a macro perspective. So I do think we need reform. And looking at it, it's very interesting to see how banks have responded to two parts of their capital buffers. One part is the so-called counter-cyclical capital buffer that we set. And what's different about that is that when a stress hits, we release it sort of formally. So banks have the capital, but we've released it, so the banks know they can use it. The rest of their capital buffer isn't released like that. And it's interesting that they have a completely different approach, a good approach to the first of those and a less good approach to the second. So my sort of utopia for the future is that we just simplify banks' capital requirements and say, right, we're just going to move to you having a minimum requirement and a buffer of capital to use in a stress. And when a stress hits, we're just going to release the lot. You're not going to be able to sort of pay it away. You will use it to absorb losses. But because we're releasing our requirements, you can be comfortable that you can use it to absorb as many losses as you take while continuing to lend. Now, that utopia may not be easy to achieve because lots of these bank requirements are by international agreement. And it's really important in the UK that we stick to those international standards, which are in effect a sort of minimum for us, given that we have a financial system 10 times the size of our economy. And we need that sort of kite mark of adherence to international standards in order to be a successful global financial center. But we can work internationally in groups in Basel and Financial Stability Board to make the case for change here. It's not that we want a lower level of resilience in the banks, far from it. Actually, we could, if we can simplify things, maybe we can go for more. But actually, it's about getting the level of resilience we've got in a more efficient way for the things the economy cares about, which is primarily credit supply in a stress. So I think we've learned a lot in the last year about the way things really work. It's really important we don't forget that, and that after this crisis, those sorts of things are reformed so it works even better next time.
You talk that being kind of your utopia, your kind of very set level. I mean, are there discussions about that? I mean, is that something that, while it's a utopia, you feasibly could come into play kind of in the coming years?
Yeah, I think there are discussions going on internationally about the way capital buffers should work, and in particular about the way some elements of them have worked pretty well and others maybe not so well. And it's that distinction, I think, that concentrates people's minds. And we'll be making the case that the level of resilience we've got is good. We just need to make sure that we're getting as much resilience of credit supply as we are as resilience of the banking system. And I think people have noticed that we now have an empirical data point in this crisis about the way things work, and it's not optimal. I'm not saying it's bad, but it's not optimal. So I think we are and will continue to work. Whether we'll get to my utopia, I don't know. But it's important to start with what the ambition should be. I should say my utopia is also based on my observation that bank capital rules currently are just too complex. I think it's probably inevitable because they've grown up piece by piece over time. But taking stock of it now, you look at it and you think, crikey, that's complex. And it's not just that it's an inconvenience and difficult to understand. I think we're at the point now where it actually has an effect on banks' cost of capital because investors don't fully understand where the various regulatory pieces might kick in. And so there's an opportunity, if we can simplify, to maybe have more resilience without pushing up banks' cost of funding. And I think, various dimensions you can simplify along. There are too many types of capital. There are too many types of constraints on banks' risk weights. You could just simplify these things without compromising the level of resilience. So now's a good time to take stock and strip out what we don't need without compromising on the level of resilience we have.
I mean, I think trying to simplify the capital rules will be music to banks' ears. The other thing that they complain about over the past year in terms of cost of capital is these restrictions on the dividends, where we've moved away from the outright ban, but there is kind of limitations on what they can do. They point out that in this low rate environment, the margins for them to massively expand lending, that in itself can make it riskier to decide what to do because they can't make so much money. And there's a lot of little small micro things they point to, the caps on overdrafts, all this kind of thing. Are there other parts of the kind of whole regulatory universe for banks that could be simplified so that in this kind of situation, they would just be extending more credit?
Very possibly, but my top three are sort of the ones I've mentioned. So one is just move to having a minimum requirement and a stress buffer that can all be released. The second is, reduce just the different types of capital that are part of regulatory framework. You could just have common equity tier 1, which is used for absorbing losses while you're in the course of business, and a separate tank of bail-in debt or bail-in instruments in case you need to be resolved. Just strip it out and be like that. And when it comes to constraints on risk weights, I don't know what the answer is, but it's clear to me the system is over-specified with a standardized approach, floors on risk weights, leverage ratios. I'm not sure which ones you end up keeping, but the system's clearly over-specified, and so you get different things kicking in at different points. Those have been my top three to reform, and I think if you do those, actually a lot of work at the prudential framework would become much simpler and actually no less effective, possibly even more effective than it is now.
I was quite intrigued by your mention of a kind of recession policy playbook and the kind of way that monetary policy and fiscal policy needs to be coordinated. Was that, first of all, a kind of indication that if we stay in this interest rate environment for a long time, where rates are kind of verging on negative, that there's actually kind of, the additional ammunition for central banks is kind of limited. So you need a kind of set framework for what would happen on the fiscal side.
Yeah, I mean, I don't think it's a particularly radical point to acknowledge that central banks have less room for manoeuvre now than they did in the past, with the yield curve, as you say, so very low and pretty flat as well. It's not to say monetary policy is out of ammunition. We've seen in this crisis how it can still be very, very effective. It's just that it has less than in the past. And so in the spirit of worrying about what could happen in the future, we should think about how to deal with that in case of if and when a recession does hit in the future. And it's clear that if we want to stabilize output and employment and avoid deep risk, actually fiscal policy needs downturn. That has happened. Both fiscal and monetary policy itself very nimble, very effective.
Sorry, we're just, it may just be me, but I think we're just having a little losing your feed slightly, Alex, but I'll just kind of go over my next question, and then hopefully maybe your link might have
Can you hear me now?
Yes, that's better. Thank you.
Very good.
Perhaps we could just move on. Maybe we could just move on to kind of how would that kind of coordination mechanism work? Would you have a framework kind of in place before a crisis hits, so that if certain economic indicators or whatever hit some kind of red level, there would be a fiscal response, to kick in?
Yeah. I mean, I don't have all the answers here. I just think it's something we should think about for the next crisis. But there are two things that occur to me if you've got both monetary and fiscal policy in town during a recession and the need to coordinate. The first is you need mechanisms to avoid underlap, effectively to avoid both authorities thinking the other one has it covered. Now, that hasn't been a problem this time at all, but we need mechanisms to make sure it isn't a problem in the future as well. So does it, for example, mean that the monetary authority has to notify the fiscal authority when it thinks there are meaningful downside risks to inflation that it can't deal with? Does the fiscal authority need a pre-committed plan if it receives the baton in that way at any point? But those are all in the spirit of mechanisms to avoid underlap. And then on the other side, you need mechanisms to avoid damaging the credibility of the inflation target. That hasn't happened this time. And there's no need for it to happen in future. You just need to make sure that to the extent fiscal policy is active in a downturn, like it has been, that it doesn't do anything that compromises the ability of monetary policy to tighten later, should that prove necessary. So these aren't insurmountable issues. And in fact, the experience of the past year offers a lot of pointers. It's just really important that we sort of hardwire this for the future, recognizing that we're in a different interest rate environment. And it's really important for financial policy for the reason that while monetary policy is more constrained than in the past, and while we don't have a new recession policy playbook, actually we have to acknowledge as financial policy makers that there may be more risks to output and employment in the future than there were in the past. And that would mean that we need to put more resilience into the financial system to cope with that extra volatility. And I think it's just an example of where we need to think about all these policies in conjunction with each other when we're preparing for the future. And it's not that these issues are insurmountable in any way. I'm just applying the logic that we've applied to worrying about things that could happen in the future, before they become an issue. It's all about preparation and acknowledging issues and preparing for them, rather than pretending you'd prefer that they went away. And I'm sure actually that based on this experience, policymakers long after I'm gone will be writing the playbook for next time based on the success of this time. And I wish them every success with that.
I'm sure you'll get a credit in there somewhere. Perhaps we could just jump to another kind of event I flagged at the beginning, which is Brexit, which on some levels it feels like we have been talking about it forever, which we have, but I guess on another level, the actual kind of after effects we're kind of only still just starting to see the impact of. I mean, just firstly, initially, from a financial stability perspective, do you regard the way the Brexit process has happened as a success? Obviously we didn't have the no deal, but actually kind of when kind of December the 31st came, actually, we saw obviously share trading move, but things were generally fairly calm.
Yes, yeah, I do. And I've thought about, as you say, it's dominated our lives for a long time now. I've thought about this a lot. And it goes back to what I said in my opening remarks, that we spent a lot of time just asking ourselves, look, could there be, firstly, a no-deal Brexit more broadly, and within that, could there be a separation, effectively, of financial services? Could there be halt to the cross-border provision? And the answer to both of those questions from the get-go was very obvious. Yes, it could. We could have those outcomes. And so we prepared for them. And that meant that the system was prepared for the event of a no-deal Brexit, including no deal on financial services. Without the preparation, without the constant sort of monitoring and the checklists and the actions by a whole range of authorities and firms themselves, just a sudden break would have caused very severe disruption in some very important markets. We didn't see any of that. And it does show the value in preparing for these things over time. So yes, in that sense, I think it is a success.
And do you think, a lot of the debate now is about equivalence and whether Brussels was keen to give that or not, and what it would mean in effect if it's something which could just be kind of switched on and off. Do you see, do we need equivalence? Is that something that kind of occupies your time a lot at the moment?
Well, decisions on equivalence aren't really aren't at all for the Financial Policy Committee. I would just say this from a financial stability perspective. It's that equivalence that signs you up to being a complete rule taker is potentially very problematic from a financial stability perspective. It potentially signs you up to rules that are inefficient. In the limit, it signs you up to rules that might be ineffective for a financial system that's 10 times the size of your economy. Rules that the EU might decide are adequate when the largest financial centre is 5 times the size of the economy, actually may not suit us. And it may also not be particularly effective, since the areas of business covered by equivalence deals are not actually that vast. So I think it would be pretty short-sighted to say, look, in order to keep as much business as possible here, we need to sign up to these things, because that could be quite risky for stability. I would say, though, that we are pretty committed to an open global financial system. It's good for the world. It's good for the UK as a kind of hub of that system. So it's really important that we lead by example, continue to adhere to agreed international standards, which should probably be a minimum for us, actually, so that we continue to have that sort of kite mark that's needed to be a global financial centre. Now, if others choose to withdraw from that global financial system a bit and impose costs on themselves, that is actually for them to decide. We just shouldn't respond to that by things that create issues, whether that's financial stability or damage to the global financial system, for ourselves and others. So I have a bit of confidence. Don't try and take measures to just keep business here, but let's stay committed to an open global financial system.
I'm curious, just from a kind of logistics point of view, I know we had on Friday the Treasury said they'd signed this memorandum of understanding about UK and EU discussions on financial services. But do you feel since Brexit that you're kind of out of the room for some discussions that you'd like to be in the room for when kind of EU finance discussions are taking place?
I'm not sure about that. I do know, though, that effectively our relationship with the EU has moved on to the sort of footing we have with lots of other jurisdictions. We're no longer part of the EU, just sort of not part of other jurisdictions. And we're quite used to cooperating with a range of jurisdictions. And actually that cooperation is an essential part of having an open global financial system, because no country can separate itself off entirely, what with free movement of capital and an open global trading system. So the dangers in fragmenting are that you get sort of opaque, complex links between financial systems. And those need monitoring, they need discussion so that we all understand the risks, and they need kind of discussion so that we all know what each party is doing about them, and we can defer to each other. So I'm very pleased actually that about the news on Friday that the MOU is on the way, because it effectively puts us on the similar footing with the EU to where we're on with lots of other jurisdictions, which is that we cooperate with them in order to manage the risks so that we can have an open global system without some of the problems that could otherwise arise from it. But I don't think I've felt particularly that it would be better to be in a particular room at any time. But I think it's important looking ahead that we manage the risks around this new system, this new slightly more fragmented system. And that is going to require a degree of engagement and cooperation. And hopefully this puts the mechanisms in place to do it.
The fragmented system, share trading is now fragmented between more markets. Is that something which kind of on your financial stability dial kind of, elevates risk at all? Or is that kind of fairly kind of minimal issue?
Well, I don't think it's a major issue in and of itself, but what it does is sort of highlight that you're not completely separating financial systems. They still remain connected. They're just connected, as I said, in slightly more complex, more opaque ways. And the risks are more difficult to manage because you need two parties, two sides to manage the risks rather than one. And so the solution is to talk about it and build a shared understanding and take action together in the same way as we do with lots of other jurisdictions. So you have to be alert to it. There are potential risks that arise from it, but they can be managed. You just need the mechanisms to do it, which is why having those in place is a big positive.
I want to switch now. One kind of interesting effect we've seen during this pandemic is that obviously it's hit some people from an economics perspective incredibly difficult. But for a lot of people, they build up this huge pool of savings whilst we're all not going on holiday or eating out, etc. A lot of that is finding its way into the stock market, into other savings products. We saw the GameStop phenomenon in kind of earlier this year. How closely are you watching that? And is that giving you a new kind of cause for concern in terms of what kind of can cause sudden swings in markets?
Yeah, I don't think anything we've observed actually from a financial stability perspective is a cause for concern. But there are a couple of episodes over recent months or over the past year actually give us things that we need to make sure we're monitoring for the future. You mentioned the GameStop episode, for example. I think what that highlights is that sometimes the way markets operate does change. We've seen a big surge, as you say, in the US in the degree of retail trading over the past year. And it shows the importance as those things happen of the regulation and the infrastructure actually keeping up with the new way the market operates. Because what we saw in those episodes was that, on occasion, trading had to stop while the platform tried to post margin with its clearinghouse. So margin is a good thing, protects people. It's just really important that in future, as these things develop and they become more widespread, you don't get sudden disruptions to trading activity because the platform perhaps is scrabbling around for cash to post margin. In this case, it wasn't a systemic issue by any means, but it does give us a glimpse on the sorts of things that could be important in the future. And that's why when we look at any of these things, even when they're not systemic, we check that, okay, are we monitoring this sort of thing so that if it grows, we can make sure the right guardrails are in place in the future? Because the sort of general philosophy of the way we regulate now isn't to just have a rule book that says, right, this is it, this is the Bible, this is all the rules that we'll need forever. It's to say, well, look, there is a rule book, but actually the objective is an outcome, it's financial stability. And if something changes, that means we need new rules, new guardrails, then actually you need to recommend them to the government. And we have a duty actually to make recommendations to the government where we think things need to change. So we're constantly monitoring these sorts of things. None of them have reached the level yet where action needs to be taken, but the recent events do offer some glimpses about the need for some things to keep up as the way markets operate develops.
And obviously it's very current, but obviously we're seeing just today huge fallout at certain banks as a result of a US fund having to deleverage very quickly. And in fact, if I understand it was a family office, so it wasn't even kind of subject to the same type of rules that a hedge fund would be. Is today's event in particular, is that something you've been following closely, and does that point more broadly to the need to kind of move perhaps to bring some types of firms more closely inside a kind of regulatory net?
Yeah, I mean, I won't comment on today's episode, which is about individual firms. And as you'd expect, we're monitoring that pretty closely, and the supervisors of the relevant firms are closely engaged. I would, though, sort of step back, as you were doing there, Rachel, and make a couple of more general points. The first is, not just this week, but over recent months and perhaps the whole year, we've been reminded, if it were needed, that the sort of non-bank system and the banking system are not two hermetically sealed separate things. What happens in one affects the other, and we need to take account when we're thinking about the stability of the system, about those kind of spillover effects that go between the two. And that's what we do when we think about the stability of the system. But the other point I would make, and you alluded to this in the question, is we saw last March, actually, how actions by hedge funds and others can effectively help to disrupt important markets. Now, this week, we haven't seen disruption to important markets, but actually it's a reminder, what's happened over the past year is a reminder that excessive leverage in some parts of the financial system can, when it unwinds, effectively make these things forced sellers of assets in important markets that then knocks on and affects the economy. And so you never want regulation to protect investors like this from themselves. They're deliberately taking risk, and they should bear the consequences of that. What we need to investigate is whether there's a case for guardrails to avoid, as I called it earlier, collateral damage on the wider economy as these sorts of positions are unwound. And we haven't seen that really here, but we did see some evidence of it last March. And that's why things like hedge funds are on the list that the Financial Stability Board and the G20 are exploring.
Thank you. I'll go through, had a lot of good questions actually come in through the audience, so I'll go through a couple of these now. First one I'll go for is, we've seen bond yields have surged in financial markets lately. At what point would this become a risk, and what stress measures do you look at to get a handle on tightness?
Okay, that is a good question. Bond yields have risen pretty sharply since the turn of the year. Actually, it's never that there's a sort of level that you think a bond yield is a problem. You've got to ask why it's moved. And in large part, since the turn of the year, what's happened is people have revised up their expectations of growth. They've revised up their expectations of the future path of interest rates, and bond yields have moved accordingly. So a lot of that is a sort of good news move in bond yields. What we haven't seen particularly this year, but that we did see last March, is where bond yields move very suddenly, not because of any reassessment of fundamentals, but because individuals in the market, or the market structure itself, is coming under real pressure. And so you look for indicators of liquidity problems in the market, bid-ask spreads widening out, the cost of trading increasing a lot. And indeed, you look for sudden movements in yields that don't seem to be associated with moves elsewhere. And that's exactly what we saw in one of the weeks last March. We haven't seen it this year, although we've seen some small pockets of illiquidity, particularly in US markets, as they've moved very sharply. So I don't think it's that there's a sort of level at which bond yields are a problem. You've got to ask why they are where they are. It's when they move, are you seeing sudden moves that aren't driven by fundamentals, but are actually driven by pressures on the people in the market? Because that's the sort of vulnerability that over time we will need to address.
Thank you. Another question which goes back to our discussion about banks and capital and the buffer. How is buffer use consistent with dividend bans?
Yeah, that's a good question. So, to start with, last March, it was an exceptional time. It was the point of maximum uncertainty about the virus, about the effects of the public health measures on the economy. And just at that point, banks were about to put £8 billion out of the door in a distribution to shareholders. So it made, I think, in those exceptional circumstances, made a lot of sense to take an exceptional action and hold back that dividend. And I should say, a dividend delayed like that isn't a dividend denied forever. We're not asking banks to run with higher capital levels forever. So it's just asking them to hold that back, see if they need it, and if they don't, can be distributed later. So I think, I was fully supportive of what happened last March. I think the difficulties arise, and it's actually an element of the current capital framework, where when banks trigger or sort of fall below a regulatory buffer threshold, they start to get restrictions on their dividends. And that's the sort of standing framework. And that's not ideal because it creates incentives for banks to try and defend against, tipping that point. And that's actually one reason why I'd like to see this sort of fully releasable stress buffer in my utopia, because as you release it, you effectively say, right, we're reducing the threshold at which you would hit those restrictions. And that's what happens with the counter-cyclical buffer. It's what would happen in my utopian stress buffer as well, because yes, it is creating a sort of unintended defense target, a target to defend for banks that we don't want. And that's why we need to move to a system where, outside these very exceptional circumstances of last March, actually banks retain much more ability to influence their own decisions over their own distributions.
Thank you. We've got one, it's kind of in relation to events today, but I know you can't comment on specifics, but I'll go to the more general point that it's raising, which is, do you think in general banks' risk management has kept up with the growth of financial markets?
In many cases, yes. And supervisors work with the individual institutions to make sure that they know what risks they're facing. But there'll always be occasions where banks take losses. That's the point of taking risk. What matters is that banks are able to manage those risks, and if they do experience them, that it doesn't have this sort of collateral damage on the wider system. And perhaps I use the example of last March, when actually the core of the banking system was largely protected from what was happening in financial markets because it built the resilience to it. So even though some banks would have incurred losses back then, the ability of the banking system to lend. So I think that resilience is the kind of core thing. And then individual supervisors will work with management practices. And anything happens of the sort we've seen in recent days and weeks, supervisors will all the lessons can be learned if any need to be learned. And I don't presume any of those in this case. But I think the general point is we've got more resilience in the banking system. So when they do take losses on whatever, whether that's market investments or credit investments, they're able to absorb it and keep lending to the wider economy.
Thank you. I might jump just back to your remarks you made at the beginning, and perhaps in your third point, you were talking about climate change kind of being this kind of new risk you need to go into. How much though is this of one? I mean, a lot of what you do is prepare for the sudden, unexpected events, that there's a global pandemic coming, that there's some huge political event that markets were expecting would go the other way. And that's a lot what financial stability planning is for. For something like climate change, how does your approach change when you look at a risk like that, where it's obviously a huge risk, but it's a kind of, in one sense, it's less likely to have the kind of sudden nature of some of the other events we see?
Yeah, I think it is a different sort of nature of risk, but the general principle applies, which is you should start worrying now about what could happen in the future. And I think our general approach on climate change, and this actually is at the heart of the stress test we're launching this year, it's the first of its kind, is to make sure that banks and insurers are actually making a proper assessment of the risks on their exposures. By which I mean an assessment that doesn't just look at the sort of backward look of how risky an exposure has been in the past, but looks at how risky it's likely to be in the future, given this government and other governments' commitments to get to net zero carbon emissions. And that's important for two reasons, really. One is that it's really important for their own risk management to actually capture, if you like, the true risks in these exposures. And the other is, it's really important that for the allocation of capital in the economy, because while people are measuring things on a sort of backward look in risk, things that are driving us towards net zero will have too high a financing cost, whereas things that are not driving us towards net zero will have too low a financing cost. So in encouraging banks and insurers to think about the true risks, you can actually get financing costs for different sorts of investments in a more accurate place for the future, which will help us to support the important transition of our whole economy to meet that government commitment of net zero carbon emissions. So we're doing it consistent with our objectives, but actually it has this positive benefit of helping to allocate capital more effectively to achieve that ambition.
Do you think then we've obviously got, as you mentioned, the stress testing exercise underway. Once you go through that, do you think how different banks perform under that exercise could influence what their capital requirements will be?
Well, we've said that this year is an exploratory exercise mainly designed for, to shape up their capability in this space. And they've been investing vast amounts in their capability here to assess on their individual corporate exposures, how exposed is this to the transition to net zero? And to do that properly, you have to look not just at the carbon emissions of that company, but all through its supply chain as well to really get at it. And that's a big job for them. And that's what this exercise is really designed to do, is to test their capability and to spot gaps in that capability. It will also give them a sense of quite how much they need to adjust their exposures over time in order to reduce their risk, given the transition to net zero. And in doing so, gives them a sort of strategic benchmark to adjust to. I think over time, you can imagine the tests getting tougher and there being capital consequences. Because as I say, really what we're doing here is trying to capture the true risks of the exposures. And if an exposure has higher true risk because it hasn't got a plan to transition to net zero, it's going to be more risky, therefore, in future, and it probably needs more capital against it. That's a natural sort of next step in this stress testing program on climate. But none of this, to be clear, is about, thinking of climate as an add-on to normal risk management. It's part of, and it should be part of, normal risk management. The government has told us it wants to achieve net zero by 2050. The risks in all the bank and insurers' exposures need to reflect that.
Okay. When you're looking at the kind of the risks and perhaps the nearer term risks that your successor might face, I'm wondering, there's one or two kind of events on the horizon that are coming up. One of them is kind of the political situation in Scotland, and we might see again at some point some kind of independence vote there. Is that something that you're looking at closely again?
Well, we'll look at that if and when it becomes relevant again. I mean, I spent part of my career looking at this back in the last referendum. And again, we applied, once the referendum was called, we applied the principle we've always applied of not trying to forecast the outcome, but just preparing for what could happen. We've subsequently released some of the details about the contingency plans we had in place. It's not for me to predict what will happen in the future, but these things only generally kick in once the politicians and the electorate have decided that they want to take a particular course, to have a referendum. It's not for central banks to prejudge that, but if anything like that ever happens, as it did in the past, we take our normal approach to it, which is to ask what could happen here and what contingency plans do we need to put in place.
We're edging up towards, I think, the end of our hour. It might be interesting, you've obviously lived through some kind of very hairy moments during your stint at the bank. You're obviously working very closely with Mervyn King in the 2008 financial crisis, Brexit, the pandemic. I'm just wondering if you could share with us perhaps an anecdote or two from, one of those moments, which perhaps sums up the kind of tension or interesting twists that we were going through.
Yeah, I thought you might ask me this. Actually, I've got two quick anecdotes because I've been quite reflective recently. The first actually was my sort of first crisis in my career, which was Northern Rock. And I was a kind of junior official working for Mervyn King at the time. And on the day the retail run started on Northern Rock, there was an ECOFIN meeting of finance ministers and central bank governors in Europe, and it was in Porto. And the Treasury had chartered a small plane to take the Chancellor and Mervyn to Porto. And as a general rule in life, I can highly recommend not getting on a small aircraft with a Chancellor and a Governor who have just seen on the TV screens in the terminal that a retail bank run has started for the first time in hundreds of years. And I remember on that flight sort of looking into the cockpit at one point, and the pilots were holding up a big map on the windscreen, I suppose it is. And I just remember thinking, has nobody planned properly for this? And it was an abject lesson, actually, that the sort of failure to ask what UK, for all sorts of reasons, was unprepared. And now we've changed that. Is it in March last year, you know, at the height of the market turbulence we've been discussing, I led a small group of officials down to see Andrew Bailey, who was in his first week in the job, poor guy. And he says that I walked into his office and said, we need to talk. And as he said to me afterwards, when you say that, I know it's never very good news. And a counterpart of mine in another central bank was laughing at the story and said to me, yeah, you know, when the monetary policy guys walk into the office and say we need to talk, you know they've screwed up, you know there's been a forecast error, but it's 50-50 whether it's good news or bad news. When the financial stability crowd walks in, you know it's hard hat time. And I shall miss I shall miss putting on the hard hat, and I hope there will be other bearers of bad news, not so much in the future. But I guess my main reflection is that although, you know, it's crises that always are the things you remember, you know, over 21 years, I think probably the thing I'm most proud of is my tiny part in what the Bank of England has done over that long time to build things that people now take for granted, like low and stable inflation, resilient financial system. And, you know, I've played a tiny part in that, but I'm really proud of what the bank has done and that I've been able to play a tiny role in it.
And can I ask you what's coming next? What are your plans now from here?
Yeah, I don't know. I've got 48 hours more to watch what's going on around me. And I don't know yet. I will spend some time after I leave thinking about that. But I'm excited to look for a new challenge. It's a wrench to leave the bank, but after 21 years, actually, the question is why not leave rather than why leave? So I'm going to get a new perspective. As Andrew Bailey says, it's a career break, not a career end, and I'm very grateful to him for putting it like that. And maybe one day I'll return. I love the bank. I think the people there are absolutely amazing. And you know, I really believe in what it can do for this country. But for once, I'm actually, in that sense, not going to worry about what could happen in the future at all. I'm just going to find a new challenge for me next and broaden my horizons a little.
And the very cheeky question for me, but would you ever fancy Andrew Bailey's job at some point in the far future?
Anyone who saw Andrew Bailey in that week last March will realise that being governor of the Bank of England is not something that most people should aspire to. He was the right man for the moment. He was the right man to respond to my "we need to talk." He responded to it incredibly calmly, and maybe we should all watch and learn.
Fantastic. Well, I think with that is a very fitting place for us to wrap all of this up. So thank you ever so much for your time today, and thank you very much to everyone in the audience who shared their questions. And I'm sorry if we didn't get to all of them. But very best of luck for your break, Alex. Hopefully you can come and talk to us again soon, and whatever role comes your way next. Thank you to everyone for watching the Reuters Newsmaker this afternoon. I shall say goodbye.